Hello and welcome to Explain the Charts. Today is October 27th, 2025, and we are diving deep into the EURUSD pair. We'll start with the latest news and fundamental drivers before jumping into a detailed technical analysis of the charts. The dominant theme right now is the diverging monetary policies of the US Federal Reserve and the European Central Bank. The market is overwhelmingly expecting the Fed to announce a 25 basis point interest rate cut at its meeting this Wednesday, October 29th. This expectation is fueled by recent U.S. inflation data coming in cooler than anticipated, giving the Fed more room to ease. In stark contrast, the ECB appears to be on hold, with President Lagarde stating that policy is in a good place and markets pricing in very few further cuts. This fundamental divergence is theoretically bullish for the euro and bearish for the US dollar. Adding to the dollar's potential weakness is continued optimism surrounding a US-China trade deal, which tends to reduce demand for the safe haven greenback. However, it's not all one-sided. Some long-term forecasts, like one from FX Street, are quite bearish, predicting a potential return to parity for EURUSD in 2025. This bearish case points to a stronger U.S. economic recovery and potential political turmoil in the Eurozone. So, we have a short-term bullish narrative clashing with a potential long-term bearish one. Let's see how this is reflected in the charts. Okay, let's pull up the daily chart for the big picture view. Looking back over the past year and a half, we can see a clear, powerful downtrend that started from highs above 1.19 back in September. The price found a significant bottom in early 2025, dropping as low as 1.0121 in January. That level marked a major reversal point, kicking off a strong recovery rally that lasted through the spring. The price then peaked again this past September, hitting a 2025 ceiling at 1.1918 on September 17th. Following that peak, we've seen a sharp sell-off throughout late September and into October. This brings us to our first key support level, which was established at the October low of 1.1542. This 1.1542 level was tested on both October 9th and 14th and has held firm so far. Conversely, the September high of 1.1918 now acts as our most significant long-term resistance. Let's zoom in on the price action since August to get a clearer view of the recent moves. You can see the parabolic rise to the 1.1918 peak in mid-September, followed by the aggressive downtrend. The price sliced through several potential support zones on its way down. Since hitting that 1.1542 low 2 weeks ago, the market has entered a consolidation phase. We've been trading in a range, roughly between that 1.1542 support and short-term resistance around 1.1728, which was the weekly top from October 17th mentioned in the news. This sideways movement is classic market behavior ahead of a major, market-moving event like an FOMC rate decision. Traders are clearly hesitant to commit to a direction until the Fed makes its move. Switching to the 1-hour chart, we can examine this consolidation range with more detail. Here you can see the bounces off the 1.1542 area in mid-October very clearly. The subsequent rally was capped just below 1.1730. Since then, the price action has been choppy and sideways, coiling up in an even tighter range over the past week. We're currently trading around 1.1630, right in the middle of this recent micro-range. There's a minor downward trend line that has defined the pullback from the 1.1728 high, which sellers have been defending. Buyers, on the other hand, are supporting the price above the 1.1600 level. Finally, let's look at the 15-minute chart to see what's happening today. As you can see, volume is relatively light, and the price is locked in an extremely tight range. This is the calm before the potential storm. Today's action shows a lack of conviction from both bulls and bears, which perfectly reflects the broader market waiting on the Fed. There is no clear intraday trend to trade at this moment. This chart tells us to be patient and wait for the catalyst later this week. Alright, let's switch back to the daily chart and recap what we've learned. The market is at a critical juncture, balancing bullish short-term expectations against a bearish longer-term trend. The key event is the Fed's interest rate decision on Wednesday. Your key upside levels to watch are the immediate resistance near 1.1650, followed by the October 17th high at 1.1728, and then the October 1st peak around 1.1778. To the downside, the most critical support is the double bottom at 1.1542. A break below that level would open the door for a move towards the 1.1400 handle. Now for our unbiased predictions. Scenario 1. The bullish case. The Fed cuts rates by 25 basis points as expected and signals a continued dovish stance. In this outcome, the US dollar would likely weaken significantly. We would expect EURUSD to break above 1.1650 and challenge the 1.1728 and 1.1778 resistance levels. I'd place the probability of this scenario at around 70%, as it aligns with current market consensus and recent data. Scenario 2. The bearish case. The Fed delivers a hawkish surprise, either by holding rates steady or by signaling that this is the final cut in the cycle. This would cause a strong dollar rally. We would see the critical support at 1.1542 break, with sellers likely targeting 1.1400 or even lower in the following days. Given the consensus, I'd put the probability of this hawkish surprise at around 30%. So, the main thing to watch for is the FOMC statement and press conference on October 29th. Any deviation from the dovish expectation will cause significant volatility. Keep a close eye on those key support and resistance levels when the news breaks. And finally, a quick disclaimer. This video is for informational and educational purposes only and should not be considered financial advice. Trading Forex involves significant risk, and you should always do your own research and consult with a qualified professional before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you next time.